Hey everybody, William Tovar with Nova North County. With increasing market activity, we've been getting a lot of buyer questions lately, and the one question that we've come across more often than not is what is an FHA loan and how does it work? So today I will be sharing a brief overview of the Federal Housing Administration and their loan products, but over the next few weeks we're going to be doing a video series on this based on the questions that we get from the video. So like I said, general overview today. Any questions that get sparked from this, definitely ask them in the comments below and we will make a video about it. So let's get into it. The FHA was created by Congress in 1934 for the purpose of regulating interest and mortgage rates and mortgage terms after the banking crisis. So we all remember from history class, 1930s, Great Depression, wah wah wee wah. Well, here's the FHA to save the day. Since then, they have insured over 35 million mortgages, which makes them the biggest mortgage insurer in the world, and they've done all of this without costing the taxpayer a single dime, which is pretty impressive by government agency standards. So today their mission honestly remains pretty much unchanged, and that's just to help people qualify for loans and reduce the risk to lenders issuing those loans. So that's really good information, but how does the FHA actually help buyers or help me or help you? Well, when you or a buyer takes on an FHA loan, they are going to be required to pay private mortgage insurance. This is the insurance that protects a lender should the buyer ever stop making payments and default on that loan. That insurance breaks down into two different premiums. The first one's called the upfront premium, and it's 1.75% of the amount borrowed. There she is. And this premium can be financed as part of the loan, so have no fear. The second premium is called the annual premium, even though it's paid monthly. This premium, it's going to vary depending on the length and the amount of the loan, so they're all different. But now that you've paid these premiums and the FHA is involved and the lender is now sharing the risk of the loan with the FHA, in insuring that loan, you're able to get a competitive interest rate and more relaxed qualifications when trying to qualify for these loans. So here's some of the rules that you need to be aware of when using an FHA loan. The first one is that you have to purchase your primary residence. Don't let that deter you though, because that might sound limiting, but it really isn't. What that means is that you can still buy a single residential home, a condominium, a townhome. You can buy multi-unit properties, up to 4 units though, so keep that in mind. So there's lots of home options out there to choose from, even though the rules state that you need to use an FHA loan for your primary residence. Also, when you're using and actually applying for an FHA loan, you need to be able to show job stability. What that means to the FHA is that you've held a continuous job for at least 2 years. And in those 2 years, you've also maintained a steady income, consistent income. You don't want to see any ups and downs or unaccounted time off, so keep that in consideration. And then as far as credit goes, if you've had any hiccups or less than perfect credit, do not worry, because the FHA can still be an option for you. The requirements for credit scores have been set at 580 or higher, as long as you put down the required 3.5%. That 3.5% is way lower than some of the down payment requirements for a conventional loan, which can go up to 20%. So if you've got that 580, 3.5% down payment, it's pretty good, and I'm getting dried off on by the puppies that are going in the river. So what about bankruptcy? Well, the good news for you is that you could still qualify for a FHA loan, 2 years after the discharge of the bankruptcy. As long as you've continued to show good credit worthiness and built your credit score back up, you should be good. You will be good. I don't know why I said should there. You will be good. So like I said, with bankruptcy, it's 2 years after the date of discharge, and that you've continued to show that credit worthiness. Some of the things that will disqualify you from using an FHA loan, the primary one is any federal tax liens. So if you have any tax liens or student loan defaults, that's going to disqualify you from using that FHA loan. Just want to throw that out there. So what questions do you guys have? Let's talk about it. I know that was a lot to digest and listen to, but if that sparked any questions or any comments, I'd love to hear them. Put them in the comments section below, or check us out on the blog. We'll be putting that out as well. Like I said, this is the first general series of the FHA loan videos that we're going to be making, so I am definitely excited to put out some more information for you guys, and I hope you have an awesome rest of your day. I'll talk to you guys soon. Bye.